Did you know that in 2008, the stock market had one of its worst years ever? How did your investment portfolio hold up? How about when the tech bubble burst back in 2000? If you're like most people, you probably lost a lot of money. Okay, never again, right? Well, what changes have you made to your portfolio to make sure? Again, if you're like most people, probably not too many. Fortunately, the stock market, with a lot of help from the Federal Reserve, has recovered strongly over the last couple of years. Unfortunately, the old adage always remains true. What goes up must come down. Are you ready this time? At Leap Wealth Management, we engage in an investment process called Advance and Protect. Advance and Protect is a capital preservation model with an offensive strategy. More simply put, that means we're going to try and capture growth when the market is rising and protect capital when the market is falling. We do this by using strict buy and sell decisions for each individual investment in our portfolios. This diagram is a very simple way of illustrating the objectives of Advance and Protect. Of course, we can't guarantee perfect entry or exit points, but in general, the objective of Advance and Protect is to participate in the market when it's advancing and move out of the market when it's falling. So why use Advance and Protect now? In our current market environment, we face many different challenges: high unemployment, massive government debts, runaway deficits, a declining U.S. dollar, and many other economic hurdles. So far, these roadblocks have provided little resistance to this recent market surge. However, at some point, the market may begin to weaken. Wouldn't it be nice if you had a way to stay in this market if it continues to advance but protect yourself once it begins to decline? You may be asking yourself, isn't my financial advisor already doing this for me? Possibly. However, most financial advisors subscribe to a philosophy known as modern portfolio theory. Modern portfolio theory basically says that you should control the risk of a portfolio through asset allocation. You match the allocation of stocks, bonds, and cash to a person's risk profile, and you keep the allocation intact at all times. Then you rebalance your portfolio periodically. This model encourages investors to establish a buy and hold mentality, regardless of current economic conditions. Their theory is based on the belief that if you try and time the market and happen to miss a couple of good days, it can greatly reduce your overall performance. At Leap Wealth Management, we believe that our Advance and Protect system is a much more dynamic process. Instead of sitting in a buy and hold model, as modern portfolio theory suggests, we will weigh the risks and opportunities of each individual sector of the market and invest accordingly. So for the market sectors that are advancing and showing strength, we will reduce our cash position and invest in those sectors. When these sectors begin to show weakness and decline, we will increase our cash levels and move money out of those sectors. Many financial professionals are familiar with an article written by Paul J. Guyer in the May 2005 issue of the Financial Planning Association Journal. In this article, Paul discusses modern portfolio theory and stresses the importance of using a buy and hold investment approach. He backs up his theory by showing us that an investment made into the S&P 500 index would have produced an average annual return of 17.89% if held from January 1984 to December of 1998. However, he also concludes that only a handful of the trading days were responsible for most of the overall return. According to the article, if you missed the 10 best trading days over this 15-year time period, the S&P 500 returns were reduced from 17.89% to 14.24% per year. If you missed the best 20 days, 30 days, or 40 days, then the returns continued to decrease to 11.99%, 10.01%, and 8.23% respectively. What the article fails to mention is what happens to the returns if you miss the worst trading days. So looking at the same time period, if you missed the 10 worst trading days, your annual return would have been 24.17%, not 17.89%. 20 worst days, your annual return would have increased to 27.04%. 30 worst days, your annual return would have increased to 29.45%. And finally, if you would have missed the 40 worst trading days out of this 15-year time frame, your annual return would have climbed to 31.66% per year, almost double the annual average return of using a buy and hold strategy. And finally, what would have happened if you missed the best and worst days? You still would have beaten the annual buy and hold return of 17.89% by approximately 2.5% per year. This was regardless of whether you missed 10 days, 20 days, 30 days, or 40 days. Now, why are we going through all of this? This is basically what our Advance and Protect system is designed to do. Remove the peaks and valleys from a market cycle and capture a more consistent rate of return. Now that you have a better understanding of the two theories, let's take a closer look at one of our actual portfolios. The Leap Wealth Management Core Portfolio is a portfolio we use in many of our clients' accounts. This growth-oriented portfolio consists of 7 diversified exchange-traded funds, or ETFs, that can allocate money to several different market sectors: large, medium, and small company stocks, international stocks, and emerging market stocks. We can also allocate money to a gold and commodity ETF. The chart you're looking at compares the performance of our portfolio versus the S&P 500 index since January of 2000. The blue line is the Leap Wealth Management Core Strategy, and the black line is the S&P 500 index. The chart also shows year-over-year performance for each strategy and how a hypothetical investment of $100,000 would have performed in each. As you can see, when the S&P 500 posted positive returns, the Leap Wealth Management portfolio captured similar returns. However, when the S&P 500 posted negative returns, the Leap Wealth Management portfolio did a much better job of preserving capital. Again, advance when the market is strong, protect when the market is weak. It should also be noted that the performance of the Leap Wealth Management portfolio is net of the fees we charge for our services. This is just one example of the many portfolios we have at Leap Wealth Management. Once we better understand your objectives, we'll be better able to determine if you should invest in a model that includes stocks, bonds, mutual funds, or ETFs, or a combination of these strategies. We also assist many of our clients with their 401k plans using this same approach. Please call or email us for a complimentary consultation. We would be happy to meet you in person, discuss over the phone, or set up an online meeting.